Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining us. On tonight's show, we try to find some investment ideas following Square's proposed takeover of Afterpay, and we do that with Prime Value's ST Wong. He looks at the potential digital disruptors which are eating the big boys' lunches, especially in the banking space, and he pinpoints some miners who will do well in the new age of electric vehicles and, of course, battery technology. Then we meet the CEO of the listed company Straker Translations, which has had a good 12 months on the stock market, but what is the future of this company? And then Ying Yi Ann Cheng looks at what's happening with interest rates, and Michelle May tells us what a buyer's agent is seeing in the property sector with the imposition of lockdowns. That's a show, so let's kick off with ST Wong from Prime Value. And first up, we're talking to ST Wong, the portfolio manager at Prime Value. How are you, mate?
I'm good, Pete. Keeping well in Melbourne.
Yeah, lucky you in Melbourne, which is something we haven't been able to say for quite some time. Now, mate, I wanted to talk to you first of all about what the Afterpay takeover by Square really means. And, is there an important lesson for investors coming out of this particular story? So why don't you give us your take on what this Afterpay story tells us?
Yeah, absolutely, Pete. Really interesting acquisition by Square, but I think it kind of encapsulate what it's all about in that space, which is really about, I guess, in many ways, intersection of between software and payments. A lot of changes happening in the payment space globally, also touching Australia. But the two key points that stuck out for me where Square and Afterpay is concerned is really distribution, which Square is best in class, and product innovation, which what Afterpay has shown itself as great in terms of being, I guess, stars of the buy now, pay later space. So the combination of Square and Afterpay, I think, kind of encapsulate this intersection of what's happening in payments and really the engagement between software, the consumer, and the merchants or the seller in this respect. So a lot of changes I'm anticipating to happen in that space, not just within the buy now, pay later space, but how do the incumbents, the banks themselves, react to this disruption? So that's an interesting space that I think will play out over longer term.
Okay, we'll go to that, the fear of the banks and disruption in a moment. But a question I've been getting and a question a lot of people like you would have been considering is, well, okay, Afterpay's been given this large valuation. Do we now go and look at Zip and think, well, does it have the potential to be chased by other organisations that compete with Square or whatever? Have you put your grey matter around that particular question, ST?
Yeah, it's a hard one to actually pinpoint, Pete, because the life cycle of each of these players are quite different in themselves. So to actually put a multiple on revenue, for example, on Zip or OpenPay, for example, which is large in Britain, it's quite challenging. It really boils down to what the value proposition that each of these players will bring to the players themselves. So you might be able, apply a multiple of what Afterpay has been acquired for on Zip and kind of assume perhaps a discount or premium to where you think each player is positioned to. It gives you a relative sense of valuation, but it doesn't actually give you an absolute sense whether the combination of, say, Zip and someone else actually makes sense, because it all really depends on the outcomes. And in this case, I think a Square and Afterpay combination has got tremendous potential still to be realized, of course. That will come in the next couple of years. And it really boils down to what sort of combination that Zip might come up with if they do get acquired or if they do merge with someone else. So it does put a spotlight into this space, but it's still a challenge trying to actually put a valuation on the sector per se. That's my take on itself. So if I were in the box seat of trying to make a decision whether I should be buying Afterpay or someone cheaper such as Zip, my sense is I'd go for the best in class. And in this case, the combination of Square and Afterpay seems pretty compelling in my view.
Yeah, because I'm thinking that if you look at Square's number one local rival, that's TYR. TYR and Square compete in the same kind of space. And then, so therefore there may well be a lot of good sense of TYR and Zip connecting up, which would give them strength in the local market, wouldn't necessarily help them in the external market. But I'm just wondering whether people at TYR would be thinking, well, if Square's going to leverage off all the Afterpay customer base here in Australia, we may well need a bit of support, and therefore TYR is probably the perfect one to go for.
Absolutely. My inclination from 2 years back when kind of TYR came on to the ASX is that it probably would make an ideal partner for Square within the Australian market. Payments, land grab by TYR, and that's kind of what Square is doing as well. The limitation of where TYR is concerned is that it is still one largely Australian base. What Square does bring to the game is that it has shown itself to be a best-in-class company where product innovation is concerned. You look at its ability to launch and quickly scale products offering. That's been spectacular, which TYR is still yet to demonstrate that capability. So there is still a big difference between what Square and what TYR is in combination to a buy now, pay later player in that sense.
Okay. Using the information you provide around digital disruption and the threat to banks, are there any companies out there that you think, may already be liked by the market, but have much more potential for their share prices to go higher?
Well, I kind of extend this thematic to what's happening in the specialist wealth management platform space as well. The likes of Hub, NetWealth, and Premium. Now, they have been biting into the big wealth manager space, the likes of AMP, BT, as well to some extent Macquarie, less so, but the incumbents in that space have been saddled with old technology, and you're seeing a lot of new players, such as Hub, NetWealth, Premium, coming to the market and quickly getting a large share of the inflows into platforms for superannuation and investments. So same thematic, disrupting the incumbents by bringing technology, innovation, and in some cases, very strong distribution capabilities. So in that space, we see similar thematics in the likes of Hub, NetWealth, but what stands out for me is a company called Premium. Premium is one of the smaller players in the market. I think it is probably quite well positioned to be acquired by one of the bigger players by virtue of the fact that this becomes a scale game where technology is concerned, where distribution is concerned, and that looks fairly attractive for me, where distribution and consolidation is concerned, that's applied in the buy now, pay later space at this juncture.
Okay, so let's move out to something totally different, namely the miners. And I'm not sure if I've ever heard you talk about investing in miners. A, have you? And B, do you think the miners have some interesting opportunities? Clearly, BHP, Roy, and all of them are near price to perfection. But are there smaller miners that may well be leveraged to the new world that you think actually have value?
Absolutely. I think what's hot is obviously decarbonization, green technology, and that's offering a lot of opportunity in, specialist metals, the likes of lithium, which is currently really, really hot and exciting. I've invested through Mineral Resources as a lithium play. We felt that it was undervalued, its lithium assets in WA at that point when we invested. So that's my proxy, I guess, to the green or decarbonization theme, but also more increasingly is copper. Now, copper, I think, is really poised to do really well over the medium to long term by virtue of not just decarbonization or green technology, which is going to be really strong, but also the fact that global growth is going to continue for the next couple of years. I think that's beyond doubt. And copper, I think, is one of those commodities where it is supply constrained, right? So that's an added dimension where I think the miners will come in from my perspective. Looks interesting from where I sit in a medium to long term. Now, I have holdings in companies such as Mineral Resources for a variety of reasons, of which lithium is one of those, but also own companies such as OZ Minerals, which I think is really well managed, has exposure to copper, but its balance sheet is also really, really strong. So from my perspective, that's one company which sits really well for me in a medium to long term. Now, I know that copper price is probably at its highs, as its peaks at this juncture. So there are some concerns that copper price might actually come off or roll off in the short term. That might affect the share price of OZ Minerals, but if that's the case, I'll probably be adding to my position where some of these miners are concerned. I hold BHP. That's because the cash flow of the company is just so strong, but at the same time, I'm cautious on outlook for iron ore prices.
Yeah, well, you're the second expert in the week that said that, like copper and OZ Minerals. So, yeah, there's a strong move towards it. ST Wong, thanks for joining us on the program. Great to see you.
Thanks, Pete. Take care.
Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. Joining me now is the CEO of Straker Translations, a listed company in the AI space. They've had a pretty good year, and I'd like to see why and also what's the outlook for the company. Grant, Straker, thanks for joining us.
Thanks, Peter. Nice to be here.
For people who haven't come across you guys before, we don't really do unknown companies so much, but I don't mind introducing occasional companies so people can at least have a look at operations like yours. Tell us what Straker Translations precisely does. So
we're basically operate in the global localization industry, which is an enormous industry. So it's more than $50 billion in size, which is double the music global music industry. It's nearly as big as the mobile gaming industry. So it's a very significant industry, and it's going through change. AI is having an impact because it's making humans more productive if you do it the right way, which is the way that we do it. And it's consolidating. So it's thousands of vendors. That the top 100 companies only make up 18% of the industry. So it's a huge opportunity. And what we figured out a decade ago was that as machines make humans more productive, you will be able to leverage that in a commercial sense for the benefit of your customers and for your own benefits. And the way we see that play out is we offer better value to our customers, but we also make higher gross margins than the rest of the industry. So that's how our technology plays out. And in effect, we have a big crowd of humans. We have machines that are helping to automate the process and do a first pass translation, and then a big crowd of thousands of humans that then create that. So that's in a simplistic way, but there's a lot more that goes on, believe me.
I think the best way of understanding it would be to give us an example of a major customer. I know you've worked with some really big names around the world, and what you actually do for them. So people who are thinking about your company think, oh yeah, I can see that. I can see this guy potential. So give us a classic example of a company people might know and what you've done for them.
Yeah, so there are, as I say, there's a range of different industries and organizations. There's a company that maybe people do or don't know, depending on, there's a company called Mitutoyo, which I think is a good example. It's a large Japanese company that make micrometers and digital measuring stuff. Now, I really didn't know Mitutoyo until I actually had to get a tool for my boat, and I suddenly discovered that they made them. But what they do is they They operate right around Europe, for example, in 20-something countries. And every month they put out a brochure which has got all of their new measuring instruments and all their specials, and it's, you know, maybe 20 pages document. And so what they need to have done every month is this translated into 20 or 30 different languages. There's lots of technical terms in there. There's lots of graphical input that has to be fitted in around the text. And so we'll automate taking that source language document, putting it through a process so that all the content can be extracted, it can be translated, and then stitched back together in that document, ready to be distributed around very quickly. So that's one example, and that enables them to reach a far greater audience in the audience's language, which is improving their sales. So that's one example.
So as I'm listening to that, it reminds me of those times when people have, you know, read another foreign country's interpretation of an English guide, and the English is kind of funny and misplaced and whatever. I guess in a perfect world, you guys can translate into different languages without that kind of amusing observations.
Correct. And look, quality was an issue. I think quality now is not the main driver in this. And that's why there's 20,000 different companies around the world, because they build up a trust relationship with their customer on quality. And what you're seeing now is that speed and automation and productivity are the big drivers and the big decisions that people will be making on purchasing. So, we've won this global partnership deal with IBM, for example, and for them, it's very much not about picking size or the security of existing sort of providers, but actually going with the right technology solution that's going to enable them to take on the world on their customers' terms.
Right. Grant, anyone who's watching this might go and look at the chart, and if you look at the 5-year chart, you basically were at good levels. Everyone got smashed in the coronavirus. You basically bounced back to where you were before the coronavirus. You reported pretty well, and now you've gone on. The market's picked on you over the last 2 months. Is there a good reason why the market has gone against you?
Oh, not really, and I don't know if it's really gone against us. I think if you look at the volumes, they're quite low. It's not, you get retail that do get a little bit, they want a bit more action and a bit more news. I think if you go back to what we've said this year, we've given guidance of 50 million up from 31 million, right? So there's pretty significant, right? And we're not burning a lot of money to get there. We've got some really, really significant growth. I think the market is just waiting for us quarter on quarter to deliver, to show that growth is coming through. Now, obviously, we wouldn't have given her that guidance if we weren't confident on those numbers. So I think it's just, probably represents a bargain. I think for people that we've given that guidance, and has that been priced in, I think, in the mindset. If you look at the institutions, the large institutions, that came in on our last capital raise, they're all still there pretty much. So I think it's just retail that's driving that.
And it's profit taking as well, because as I say, you had a good year until, and the pullback is a lot less than the rise on the other side of the trend line. One last question then is, when do you officially report?
So we're a New Zealand financial year end, so we're a March year end. So our half year will be end of September, so October, normally November, we would report our half year. And then our full year, 31st of March, so it's normally April, May. So we're a little bit out of cycle, but that's quite useful, because when the Australian reporting season's full on, it gives people a chance to have a look at us when they're sort of out of cycle.
Great stuff. Well, Grant, good luck with it, and I hope you guys do well in the future.
Thank you very much, Peter. Great to be on the show.
Well, joining me now is Ying Yi Ann Cheng from Coolabah Capital, and she is the portfolio manager for the Switzer High Yield Fund. Ying Yi, great to see you.
Great to see you, Pete.
Okay, so people are getting a little bit worried about the stock market, coronavirus, the bond market. The yields have been falling lately, and of course, doomsday merchants seize upon this, hoping to get that crash that they've been praying for a long time. So you're the right person to ask these questions. So what is the bond market saying about the coronavirus Delta strain and a possible economic slowdown?
Yeah, that's definitely been factored in. So bonds are rallying off the back of this. And, I suppose, that is a good reflection in that respect, because it does convey the fact that, okay, expectations are, lower rates. And, that's because we need to put in some sort of a similar, well, at least the RBA needs to put in some sort of a stimulatory sort of a measure in order to support the economy while we're going through lockdown. And obviously the implications of both, the New South Wales and Victorian lockdowns have, profound sort of impacts on economic growth and GDP. Obviously, subject to, I suppose the economy reopening again, obviously we shall get a bounce back, but that's not something that's probably expected until, earliest at the end of the year in the last quarter.
Yeah, okay. So your colleague Chris Joy was fantastic in predicting us getting on top of the coronavirus and the fact that a vaccine would come much more before most people did. So what is his market crystal ball saying right now about the implications of this? Because sure, the bond market is responding to what might happen over the next quarter or two, but even you implied in that answer that maybe around the end of the year, we should see a rebound if the vaccination program does well. What is Chris saying to you guys in your meetings with him?
Well, I mean, look, a lot of our views, are very centred upon, RBA QE, which is quantitative easing, i.e. their bond purchases. And, really our view around, rate hikes in the future is not something that we expect until, at least 2023. We expect that the RBA will continue to be doing bond purchases well into 2022. And the RBA actually announced in their July meeting, so earlier this month, that they would move to a more flexible stance on quantitative easing. And they did suggest that they would, reduce purchases from, $5 billion to $4 billion a week. However, as we expected, that July meeting decision to reduce it from $5 billion to $4 billion was a very marginal call. And it feels like it could have gone the other way as well. And the whole emphasis for them has been on flexibility, right? So, in the case of, pre-New South Wales lockdown, pre-Victorian lockdown, going from $5 billion to $4 billion would have made a lot of sense. But you could argue that, given what we're going through now, there is probably a strong case to not necessarily, reduce from $5 billion to $4 billion. And in fact, there are certain banks that are saying that, due to the impact of these lockdowns, the RBA will either backtrack on their taper at their August meeting coming up, which is the first Tuesday, the 3rd of August, or at least say that they are considering that for their September meeting. So, Westpac has come out today, for example, they're suggesting that the RBA may actually announce an increase in bond purchases to $6 billion per week to provide additional monetary stimulus, while large parts of the economy are frozen. So, I would say that we agree that this is a possibility, as is the RBA deciding to increase the proportion of state government bonds that they are buying relative to the Commonwealth government bonds, for example.
And you guys would be happy about that, because you kind of thought that the RBA going for what I call the tiny taper from 5 down to 4 billion was maybe a little bit too soon?
Yeah, as emphasised, it's always been a flexible point of view. We actually felt that the $5 billion to $4 billion did make a lot of sense, and that's taking into account the fact that, had the RBA continued at their $5 billion per week pace, given that versus the backdrop of reduced Commonwealth bond issuance and reduced issuance from some of the states, beforehand, then, had they been continuing at the same pace, they would have actually been buying more bonds than was, issued in terms of their target, right? So 4 billion is just commensurate with that fall in issuance. But obviously we're in a slightly different situation a couple of weeks later with the New South Wales lockdown. So, as was always emphasised, flexibility is the key here.
Okay. One last question, and you know how I love to make you look into the crystal ball and make big predictions. And I know you don't like doing it, but too bad. You're qualified to do it. So my question is, will a bigger and better vaccination rate overseas and here as well ultimately lead to a more confident bond market, and eventually we'll see yields probably rising, maybe around the time you're suggesting, end of the year when things look better?
Yeah, I mean, I suppose the key point there would be, yes, vaccination rates, and definitely that, improvements in vaccination rates will have, a strong sort of knock-on effect in terms of boosting sort of confidence around, borders reopening and therefore economic activity. And so in that respect, I think the bond market will, progressively have to factor that into account. Obviously, high yields is actually not good for fixed rate bonds. It's good for floating rate notes, which is, that part of the market where we're focused on, running floating rate portfolios. So as rates move higher, on the back of, better growth, better economic conditions overall, that actually benefits us. So yeah, that is something that we are quite confident about over time, albeit we know that Australia started its vaccination path belatedly. However, it looks like we are on track and are progressing at the same sort of linear phase as some of the other sort of key developed countries that we consider to be peers. And so our house view is that eventually borders will reopen in Q2 next year following a possible election in March, and that's off the back of Australia reaching herd immunity in January or February next year.
Great stuff. Ying Yi, thanks for joining us.
Thanks, Pete.
Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. Well, we're joined now by Michelle May of Michelle May Buyers Agents, and I want to talk to her about, in an age when we're buying houses online, what are the things we need to know? Michelle, thanks for coming on the show.
Hi, nice to be here.
How popular is online auctions becoming nowadays?
Well, it depends who you ask, really, because I do know from talking to real estate agents, selling agents, they're not that keen because there is quite a bit of hesitancy still around the results. I know vendors tend to be quite nervous around it. From buyers, there's nervousness around the tech side of things, but I do think there can be an advantage to bidding online for buyers in this market.
Yes, I can. I know I've interviewed people who've had difficulty demuting their microphone. Imagine missing out on the house because you simply couldn't get heard.
Yeah, that is one of the risks for sure, because there's all these different platforms available, such as Auction Now, Gavel, but also just simple Zoom and Google Meet. Depending on what the agent chooses, I think it's important to do your research prior to just registering for the property that you're trying to buy. I would definitely attend a few other ones to see what the go is and how they run these things, because whilst we have more experience than obviously last year, it's still a bit of a free-for-all, so definitely get a bit of practice in.
Okay. What do you think are the major pitfalls that people need to be aware of?
Look, in this country, internet can sometimes still be a bit, hit and miss. So just, I think the sitting in front of your computer and not actually being part of the action can be very nerve-wracking. So I think it's important to plan it out really thoroughly in advance. So if you've got patchy internet, potentially think about hotspotting on your phone or doing the actual auction on your phone, because all these platforms are available on smartphones. Have the agent's number in your phone as well, because I've been at online auctions myself where the screen freezes or all of a sudden you can't hear them. So having their number just right there, so you can say, hey, listen guys, hold up, something's gone wrong, is crucial. I think it's important, depending on the platform that you're on, you need to be aware that everyone can see and hear you. So you can't just make up your bids as you go along, because they may hear you talking to your partner. And that is definitely something you need to be aware of. And in fact, that's one of the reasons why I bought my most recent purchase for one of my clients, because the buyers on the other side didn't realize that I could actually hear everything.
Yeah, which gives you an insight to how enthusiastic your rival bidders are to go higher.
Yeah, yes, true. I don't think the enthusiasm of buyers to buy has cooled. I think what is happening now is that a lot of vendors are holding off putting their property on the market because they are nervous to sell online, but also because it is just so much trickier to get all your buyers through your property with the COVID restrictions. Every day we are hearing new restrictions now. It's come to the point where anything non-essential, such as styling, no market appraisals also are not allowed anymore. So, the supply is going to dry up, and there's always buyers out there ready to buy. So competition is still fierce.
Do you think, as a consequence of that, if, say, for example, by spring, I'm thinking late October, early November, if the level of vaccinations has become high enough to assume that lockdowns are over, there may well be an enormous supply of property on the market, which could be a good thing for all those people who've been missing out for a long time?
Well, let's hope so, Peter, because it's about time the tables were turned and give the buyers a bit of an upper hand. But to be honest with you, the disparity between supply and demand is still so great. It would have to be a huge amount of supply. And even after last year, with the COVID restrictions then, and then we saw an influx of properties come on the market in February, it still wasn't enough. So I think that it really would have to be an external factor, such as changing interest rates or other outside factors outside of the real estate industry, to really significantly change the buyer demand out there, and hopefully get more of an equilibrium.
Are there any other problems that people should be aware of? You've identified some really interesting ones, but are there others?
So obviously, being online, it means that you will also be expected to sign online and pay your deposit right there and then, because the property gets exchanged on that as soon as you have the deposit and you've signed the contract. So check with your bank your daily limit, make sure that it's raised up to that point that you can pay that 5 or 10% deposit. Some banks do take a number of days to figure that out. So do that well in advance, and check with the agents how they would like you to pay, because there's also options such as Macquarie Auction Deft Pay, which is a much easier way to pay your deposit. And also check how they would expect you to sign the contract. It could be DocuSign, but it could also be other options. So I think the more you are across of what is going to happen in the event that you are successful, I think the more confident you'll be at auction, and the higher the likelihood you'll be successful too.
Are you finding deposit bonds are less or more popular in this online environment where you do need to cough up with the deposit?
We don't come across them that often, and quite often when the request is made, the answer is no. So it really depends on the vendor situation and the comfortableness of the vendor solicitor around using deposit bonds from a buyer. But they have always, and I think they'll always continue to be only a very small portion of the market when it comes to property buying.
Okay. Now, I know you said the supply of properties is relatively low, which wouldn't be great for your business. But the fact that people are nervous about being online, does that mean that people are actually going to buyers agents for help battling the online world?
Certainly, much like last year, our inquiries have gone through the roof because people are realizing that they need help, and this is not something they do every day, let alone that added bit of tech and the uncertainty of what's about to happen. But similarly to last year, there is a lot more off-market activity happening now because vendors are wary of using the marketing dollars to publicly display their property online. They're contacting real estate agents and say, okay, I'm open to selling, but can we do it off market? And of course, as a buyer's agent, we have those connections in the industry. And last year, for example, we bought about 50% of our properties off market during that COVID period. So the longer this continues, the longer these lockdowns continue, the higher the likelihood that more of the property market is going to go off market, and therefore buyer's agents will certainly be more in demand.
But Michelle, isn't there a problem in the sense that a buyer agent like you and others, would really want to go inside the property and really know whether this property measures up on the inside as it does on the outside, and according to what is a typical house in that area? Does that cause a bit of a problem for you?
Well, absolutely. But at the moment, we are still able to do one-on-one inspections. But there's also the option to do virtual inspections. And obviously, a virtual inspection is not ideal, but it's better than nothing, where the agent will walk through the property, or the vendor will do a video for us and show us exactly, and we can steer them and say, can you show us the laundry? All those things you typically don't see in the glossy real estate pictures. As a buyer's agent, I obviously also have access to professional tools such as RP Data and APM Price Finder. And because we have all these systems in place to do our research, we still have these processes that we can carry out when it comes to, for example, DA checks, infrastructure projects, doing research on council websites. That still continues. And obviously, it is a little bit slower. It is a bit more tricky to get our clients through. But I think we've learned a lot from last year, and we're working smarter this year for sure.
Big question, Michelle. Have you guys been defined as essential workers?
Yes, we are. That's correct.
Yeah.
So I think that is part of keeping people who are in vulnerable positions safe. I think that is one of the main reasons why we have defined as essential workers. You are still allowed to move house for the time being. So obviously we've got to be, sensible ourselves as well. It's my responsibility to do the right thing for my clients, myself, but also society as a greater good. So I think, you've got to be sensible. If there is an option to do it online as opposed to in person, then we'll certainly take that route.
Okay, great advice, Michelle. Thanks for joining us.
Thank you, pleasure.
Now that was Michelle May. That's the show for tonight. Thanks for joining us. And remember, if you want to know more about investing in stocks, have a look at the Switzer report. Go to switzerreport.com.au. Thanks for joining us. I'll see you on Monday night.